What's up guys, it's Chris here. Now, if you're watching this video, you're probably wondering what on earth happened this week because stocks and shares all over the world and probably across your portfolio headed into red territory as we saw major drops across a range of shares and indexes, and your portfolio value is probably less than it was 2 weeks ago. So in today's video, I'm going to dive into what has been going on, how it relates to China, what this means for your portfolio going forward, and what I'm doing personally in response to all of this. So let's get started. So now, first things first, how exactly do we know that there has been a downturn recently? What are the indicators that tell us that something major has happened in the markets, and opposed to just the normal day-to-day movements of the stocks in South Africa and overseas? Well, just as an example, here is an overview from my portfolio which shows you the movements of my holdings over the last 7 days. Now, this breakdown is from my portfolio management tool on Simply Wall Street, and if you want a 14-day free trial to use their premium version for your portfolio too, you can check out the link in the description, and there is also a video to show you how I use it. But the important thing to look at here is where it shows the 7-day performance, and you can see here that every single stock and share of mine is down over the last 7 days, from as little as 1.2% for my Schwab USA ETF up to over 8% for Nedbank. But stick around to the end of the video where I'll show you what I will be doing next. So because I have a very diversified portfolio with shares, indexes and ETFs split between all industries and with portfolios across South Africa, the UK and the USA, I would say it's a good representation of the market. But even outside my portfolio, we can see the very evident slide in all major market indexes when we look at the month view, with the biggest slide coming in the last week and markets down between 3 to 6% in the last 5 days. So what do we know? Well, we're going to go through the two major reasons. The first reason is one we have all heard before, because it relates to inflation and interest rates. As we continue the year, we continue to see interest rate hikes, and while inflation is starting to slow and reverse, the effects of continuously increasing interest rates will continue to show its effect on the economy. And it's a simple reason, because the higher interest rates go, the less money everyday people have in their pockets to spend, and as a result, businesses make less money and pay more on their debt. Now, because most companies report on a quarterly basis, the financial impact is delayed, and we'll possibly start to see constrained returns in the year to come, especially in the banks where rates that are too high can start to tilt their balance sheet if clients default on their debts. But at the same time, analysts have predicted a slowing of interest rates as inflation is coming down, and possibly as early as next year we might even see them slowly being lowered. And lower rates historically means higher stock prices. But although this is a factor, it's not really enough to tick the needle. The biggest reason that we are seeing all this red this last week is because of a small country called China. Now, while President Xi Jinping is, as I speak, flying to South Africa for our BRICS summit this week, he is facing an economic headwind at home. But why does the market care about China, and why is South Africa and the US and UK reeling from a country on the other side of the world? Well, simply put, it's because China is the second largest economy in the world, and most countries, including those I just mentioned, rely on them heavily for trade of their goods. Think of it this way, about how electricity is only one part of our daily lives, but when Eskom goes into load shedding, everyone is affected in one way or another. On Friday, Hong Kong's index has slid by over 20% from January, and the Chinese yuan is now at its lowest level in 16 years, and it comes from a number of problems China has been experiencing. First is that after great economic growth after COVID, that growth is now slowing down. Consumer prices are actually falling, unlike the rest of the world, and they have been facing not one but two huge real estate crises, with exports being much less than they have been in the past. In fact, the unemployment in their youth is so bad that they have stopped reporting the figures to the world after it hit 20%. And all of this has led to the most telling indicator dropping, which is their GDP growth. GDP refers to gross domestic product, which is the sum of a country's total economic output, kind of like revenue, but for a country. And major banks have cut their economic growth forecast to China to below 5%. Now, you might be thinking to yourself, wait, Chris, I last saw that South Africa was forecast to grow at just 0.3% this year, so anything over 4% is great. Well, unfortunately for China, although 4% sounds high, it is very far below its historic growth rate of 14.2% in 2007 and 8% even during COVID. We must remember that China went from relative poverty to the second largest economy in the world, so their historic growth has been astronomical, and the world relies on their growth to predict how much trade and how much income their country can expect each year. So if their GDP growth drops, our trade drops, and incomes for businesses and governments drop as well. So let's break it down into 3 sectors, and then I'll tell you what this means and what I'm doing with my portfolio. The first is property problems. China has a few massive property development companies that affect the economy hugely, as it represents 30% of their GDP, and recently one of them called Evergrande started missing its debt repayments, and now one called Country Garden has started missing interest payments as well. This has caused huge problems in the country and the economy, and now one of their largest investment trusts called Zongrong Trust, I hope I said that right, I probably didn't, that manages 1.6 trillion rand in funds, failed to repay some of its largest clients, and there are worries this could spill over into other areas of the economy. The second is government debt. Now, many countries are battling with this recently, including the USA and the UK, because COVID brought on huge unbudgeted government spending, with most countries having to borrow money in order to give out grants and support to its people in those times. And included in their debt is the 11 trillion rand bailout they gave out to their country in the 2008 financial crisis that they are largely still owing. These are astronomical amounts, and just like us, governments pay more on their debt in times of high interest rates as well. And last is a very interesting one, which is their strained relationships with trading partners around the world, such as the USA and most of Europe, due to trade disagreements, trade deficits, and most recently China's reluctance to condemn Russia and Putin over the invasion of Ukraine. And as we know, we also caused quite a stir with the BRICS summit happening this week, where I'm sure a lot of these issues will be discussed with Ramaphosa, Xi Jinping, and Sergei Lavrov, Russia's foreign minister. Okay, so what does this mean for the markets? As we saw, it means that many markets have dropped because the world expects less economic activity from China, at least in the next year, and less trade means less income and GDP output for countries in general. But at the same time, markets are very quick to react and price in these kind of predictions. So that's why in just a matter of over a week, we saw such drops all around. Now, we will see in the short term whether all of the downside has already been seen in the markets and how much was real economic change versus panic selling. Just this Monday, I saw most of my shares going up a small amount, maybe slowly correcting some of the recent drop, or we might see further drops in the short term. But just from my personal opinion, and you don't have to listen to me, but none of this has worried me too much, because as a long-term investor, I try not to make my decisions based on short-term market movements. And if you zoom out of all of these indexes that we spoke about earlier, you can see that every one of them has been through ups and downs and financial crises and recession, but that the long-term investor who has held and topped up their portfolio through all of these times will have not only made a profit, but a compounded profit through the growth of the share prices and the income of dividends throughout the years. So just today, I deposited about 6,500 Rand into my Easyequities account and put them across my portfolio. I'm just waiting for the foreign exchange to transfer, but I'll post all of the purchases in the Casual Cash Club as soon as they go through, and you can check the link in the description if you want to follow all my purchases and sales there. It's just $3 and you gain access to all 32 posts over the last year immediately upon joining, along with spreadsheets and investing tips and tricks. But guys, that is it for today's episode. If you appreciated the information, please hit the like button and subscribe to the channel for more, and let me know what you think about China's economic situation in the comments. I'm curious to hear your thoughts. But until then, I'll see you next time, as always, on Casual Cash. Cheers.